My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you make some money. My job is not just to entertain, but to educate and teach you about what's going on in these crazy times. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tomorrow morning, I think we're going to need a weatherman to know which way the wind blows. That's because if we get a good consumer price index number at 8:30 a.m. showing the economy is cooling, there's a really strong chance it could help us come up with a better forecast. That's huge going into earnings season because stocks trade on forecasts, and most money managers believe the forecast will be weaker given the economy is deteriorating. It doesn't have to be that way, though, which is one reason why we rallied nicely today, with the Dow gaining 269 points, S&P advancing 1.28%, NASDAQ climbing 1.76%. It was a very broad-based rally, done in the vacuum, of course, of no news whatsoever. Let me show you a route that could produce a positive outcome for stocks by tracing what happened last year, working backwards to figure out what the future might hold. I mentioned that we might need a weatherman tomorrow because stocks tend to go down when companies face headwinds, and they go up when those headwinds turn into tailwinds. We know last year's market was horrendous, worst performance since 2008, the onset of the Great Recession, and one of the 7 worst since the S&P 500 was first compiled. But you may not realize that there were actually 2 markets last year. You had the huge losers, which included the mega-cap tech, semiconductors, enterprise software, the SPACs, and the recent IPOs. And then on the other hand, you had pretty much everything else. For most of the year, the whole market lurched lower together, and the selling only got worse after Fed Chief Jay Powell made a big speech at Jackson Hole in late August. Sell. He picked a very scenic place to drop the hammer, didn't he? That's when I think investors began to realize, although Powell was late to starting to raise interest rates, now that he'd gotten started, he was going to continue raising rates aggressively. All aboard! Any hope for a rally, and there was one hope going into the event, as the market had been rallying since mid-June, was immediately dashed, and the market began another sickening slide. Now the mega-cap tech stocks and their tech brethren never found any footing. I think there were too many of them. They were too expensive. They had nothing in the way of catalyst to get them rolling. They kept getting clobbered. And you know what? In a lot of ways, they really deserved it because they had made so much money. But the others, like the industrials and the banks, well, they were also into free fall, too. Housing stocks were especially hard hit. These are companies that are heavily reactive to the Fed and the underlying economy. Powell's declaration of war against inflation impacted them the most. They had no underpinnings as Fed unleashed 2 Category 5 headwinds, a stronger dollar and much higher rates. That's when investors figured out that Powell seemed almost eager to take on inflation and play a lot tougher than most people gave him credit for. It resulted in one of the worst periods I've ever seen for the stock market. At its nadir, that sell-off even began to threaten the recession-resistant consumer product stocks. I mean, companies like Coca-Cola and PepsiCo, because the strong dollar was so detrimental to their business. And you would listen to these conference calls, which, you know, I like to do is they would say, X the dollar, strong the dollar, take out the strong dollar. If you dollars, you know, if you contain the dollar, currency, nothing. It didn't work. People sold stocks because the dollar went higher. But then the clouds parted, and some of the headwinds turned into tailwinds near the middle of October. And that's when we started seeing more encouraging inflation data, and the Fed let it be known that while we were in for another 75 basis point rate hike, after that, they consider scaling back the pace and the size of the tightening. Do you know that ever since then, we've had a totally bifurcated market? We've seen some remarkable runs in the traditional cyclical stocks, like we pointed out last night's off the charts, about the tremendous moves in the home builders. The companies that make things and do stuff at a profit with relatively cheap stocks saw their shares soar. It was incredible. It was a bull market within a bear market. This portion of the market's had a great run since mid-October. You know what's still going strong? It made plenty of sense. The headwinds turned into tailwinds. The dollar peaked and began a precipitous fall. The same with the yield on the 10-year Treasury. At the same time, those supply chain snafus began to adjust themselves. Fed has also succeeded in slaying the commodity piece. So the endless forecast slashing because of the strong dollar, because of the precipitous declines in how things were being produced and the predictions of how higher rates would hurt things, well, they all got tempered, even the supply chain. I can't believe they settled that. The amazing thing is that despite the downbeat returns we got for the overall market, the Dow Jones Industrial Average finished a lot stronger than all the other indices. I call it the mighty Dow because it has the most exposure to stocks that are impacted by interest rates, by the dollar, and by commodity prices. It had the most headwinds into tailwinds of any of the indices. Given that the banks started reporting this Friday, it's important to point out that they've been reacting not to how much money they make off your deposits, which is a lot, but instead to how many bad loans they might get hit with if the Fed slams the brakes on the economy. Banks also do better when there's more loan demand, and that will be in better shape if the Fed doesn't have to raise interest rates as aggressively as we thought. Now, the Fed was true to its word. We got a 50 basis point hike in December after the 75 basis point hike in November. And it's working, as we saw last Friday when we got the weaker than expected wage inflation, weaker factory orders, and weaker service data. So what makes tomorrow's consumer price index number a big deal? Simple. We're looking to see if we're nearing the end of the period where companies can raise prices with impunity, meaning without losing market share to people who trade down to cheaper knockoffs. We're also at a moment where many stocks have caught fire because we're in a news vacuum right before earnings. But there will be no vacuum when it comes to J.P. Morgan, Citigroup, Wells Fargo, and Bank of America at the end of the week. We know these bank stocks bottom when interest rates peaked. I'm talking about the ones set by the bond market. If these rates spike in response to the CPI tomorrow, I'm betting the bank stocks will go down and stay down no matter what they say. That's why we need a weatherman to tell which way the wind blows, to interpret the CPI data, because unless inflation is coming down in all the right places, this earnings season could be very rough. I only wish we had a good read on wages. The best we can hope for is the constructive monthly wage inflation number we got just last Friday. So let's put all this together. At the same time, the banks, the industrials, the home builders, and even the consumer packaged goods stocks managed to roar higher thanks to lower rates back in October, better supply chain management, and weaker dollar. Mega cap tech and friends kept going lower. They only started coming back again together once the new year got rolling and the bifurcation closed. Now, we know this cohort's been devastated by the slowing global economy. It was confusing to many people because they expected tech to go higher, along with everything else. But this is a group that always performs poorly in an inflationary environment where central bankers around the world are slamming the brakes. So here's where it gets really difficult. If inflation is low enough, as exhibited by tomorrow's CPI reading, then maybe the tech and industrial rallies can continue. But if inflation isn't tame, I think the tech started another down move. How about the rest? Bottom line, right now we are projecting big macro numbers on company sectors. But starting Friday, we make judgments about individual stocks, not broad groups. And it will begin to be every company for itself. Let's go to Arthur in New Jersey. Arthur.
Hey, Jim, booyah from Mountainside, New Jersey, just on the road from you.
Oh, man, great. Fantastic. You're just like 10 minutes from me. What's going on?
I want to first say Happy New Year to you and your staff.
Thank you, and I'm sure my staff feels the same way. Thank you.
My question for you was Zillow. Is now a good time to buy, or should I just keep the bat on my shoulder and wait for a lower price?
Arthur, I would wait for lower price. I mean, look, they screwed up. They've made a bit of recovery, but I cannot get behind Zillow, in part because, you know what, it's still too connected with the housing market. We saw KB Homes tonight report a not great number. I think the houses are okay. I'd rather have you be in other industries, though. Starting Friday, it's every company for itself. On Made Money Tonight, the market has punished the FANG stocks recently, so is it time to disentangle this acronym that I created? We're going off the charts to find out which FANG names could keep working this year. Then I'm running a screen on the S&P 500 to find names that are attractive based on their PEG ratio. And what's behind the recent rally in shares of medtech company Masimo? And can the uptrend continue? I'm finding out straight from the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.